A mentor of mine in the past used to tell me that, growth and this side of the equation is the kind of wind in the sails, and it's going to take you a long way. But if you aren't watching profitability in your finance function, then you're not steering the ship, and you could end up anywhere, including running aground or in a direction that you don't want to be. Hello and welcome to the Rule of 40 podcast, the show all about Australia's scale-ups, founders, operators and investors building global companies from right here at home. I'm Josh Askoff and with me is Jason Serter.
Hello everyone.
In our last episode, we tore apart the revenue engine, go-to-market, art versus science and how to break the founder-led sales cycle. Today, we're flipping to the other half of the equation, profitability and financial fitness. Joining us to make sense of this is Ryan Barnes, managing partner of TWIYO Capital and Advisory. Ryan has worked inside over 100 Australian businesses as a CFO, advisor and scaling partner, and I have had the opportunity to work alongside Ryan in a past business, so I know that he's one of the best in the business. Ryan, welcome to the show.
Thank you, mate.
Welcome, bud.
Thank you.
Ryan, we like to start with one interesting fact or a thing that listeners should know about you, so what's that?
I'm assuming this is it's going to straddle between personal and professional, but I'm actually I'm an accountant by trade, but I don't do my own tax return, and I'm not particularly good at mathematics. And I think that what eventually evolves in a career in accounting and being a CFO is actually more of the soft skills around English and influence and communication, which is why I think I've done particularly well. I can still do a tax return and do some maths, but there's this assumption that I can do these things and I do these things, and I always have to educate my friends when they think I do tax returns for a living.
I love that.
Which I don't.
I don't have a technical degree either, which people just normally would assume.
Correct.
So this is the thing, right? Live the dream, my friend.
So I think prior to us starting the podcast today, we were kind of having a discussion, just going back and forth, and it was a really interesting topic, so I'm going to pick up on it now. So, Ryan, you're working with founders and businesses every day. From where you sit, has the way that founders are thinking about profitability and growth changed in the last few years?
Absolutely. I mean, absolutely. Thinking about COVID and the impact that that's had on a lot of things like markets and the availability of equity, and also the amount of people that have carried debt from COVID, whether that's through people that do end up on ATO payment plans and have generally since resolved those, or they've picked up debt through that period as well. There was several years where that just became managing through that crisis and evolving and changing, and the forecast being around getting back to profitability. There were some raises that happened as a result of that. Valuations have been tested as well, but as you guys would know, the entire market has shifted away from sort of, I don't mean to say easy money, but easier money to raise, and it's made it harder, and people's attention has shifted, and the way that we support people has also changed, as well as the way we do forecasts as well. So whether that's sort of an emergency style forecast or capital raise forecast, or the amount of future capital raises that you assume in the years ahead is definitely changing the shape of that discussion.
You can't count on the next raise, right? You really got to make sure that you are ready and have all the elements in place to be able to do that. So it's harder. It's harder.
I think we have certain businesses where we do have forecasts where we do assume that there will be future raises, ones that are slightly necessary due to the working capital mix or are still going to work long term. But the reality is that for the most of our long term forecasting or capital forecasts, it would be one raise and then pathway to profitability. Like it's definitely discussed in the market, and everybody does put an overemphasis on that. And we're rallying around that, not only with the founders on forecasting, but in day-to-day behaviour as well.
Ryan, from your perspective, what is that shift starting to look like when you're working with your portfolio companies around profitability and how they balance, growth and wanting to become a big, impactful business, but a sustainable business?
Well, I think it comes down to a few things. Like, one is understanding your burn and your profitability. Like, we often work with people when we first get brought in where people have loose understanding of that, but they don't really have the basic hygiene in their finances to be able to say exactly what it is. Are they recognizing revenue properly? So many early stage businesses will just not invest in the finance function to be able to say that with certainty. So I think it's about first, bringing that to the forefront and making sure there's attention on it, and then allowing them to make the decisions from it. But I think that they're getting enough information and markers from the market or from investors or other people that the behaviour has to change. So I think people do understand that, and I think they're making that shift. They're not necessarily putting their head in the sand, and they're not recognising that. People are actually making those moves. But it is going to be harder, and I think they have to change their entire thinking around who they're talking to and why and what future acquirers will want.
I think we're very comfortable in going below the line as long as you have a considered plan. And I've been saying that contrary to what we used to say many years ago, now it's like profit in months, not years. And really what that's talking about is that happy for you to drop below the line with a considered plan to invest in order to drive growth and outcomes. But at the end of the day, the relatively shorter term horizon needs to bring you back into that profit state. And we get these questions a lot, like people say to us that, if I'm not profitable, will I be able to raise, right? Just look at me, guys, okay? Like you need to work backwards from the plan. You need to think about the things that you need to deliver to get that raise away. Profit does open a much bigger window of investors that are willing to invest, right? That is so true. So, you need to work to a plan in order to do that. And if you're burning and you don't have growth, I think that's amplified, right?
Yeah. It is interesting. Like I think, a lot of early stage businesses and scale ups, you are trying to work it out as you go. But, I've looked at a number of financial models and capital raise decks recently where the businesses required to hit, 100% of their targets and have no missteps at all to kind of make the model work. And if they didn't, they're going to be behind on their targets. They will find raising difficult.
They miss one deal, right? And then they look in a very different way, right? Like those things, it's a challenge, right?
Ryan, you talked about doing more work in that financial modelling of raise case or a worst case. Are you doing more of that now in terms of helping founders to understand where their costs are and what they can do to survive when capital isn't as easy to come by or not as cheap?
We're doing a lot more forecasting, I'd say, in general, but it's less raise case. Like it's more establishing a really tight business as usual forecasting program, which when we work with clients, we'll either set a cycle of monthly, quarterly, biannual, annual, just depending on the sensitivity of the needs of the business to not forecast too regularly, but also not enough. And it's rarely raise oriented unless someone is really specifically going, there's a strategic intention to raise money. We need to run at a loss to achieve X, Y, and Z, rather than just kind of like, we need to raise capital indefinitely because that's who we are and that's what people do. It's usually because, we want to go into a new market that we want to go and do a raise version. Whereas in the past, it was kind of like raising was just a part of what you did as you were going to a certain point over a 5 to 7 year horizon. Now it's more strategic, intentional. There's a reason you're doing that. And then most of the other conversations are just kind of like, how are we going to spend money effectively? Who are we going to hire and when? And then just dealing with the changes when a deal doesn't.
It's much harder now, right? I think it is much harder. So as a result, people are more considered in thinking about it.
Well, I find that the concept of materiality, which people always talk about, I know it's an audit terminology originally, but people talk about what's material and not. I often think that the concept of materiality, like in our view, which we often say $1 is material, but like it's so low right now because people are generally operating on their own working capital or the historic amount of surplus from a raise, which is usually not much because you've kind of already spent it. And it's about making the current metrics work, the current working capital work for you, prove that you can stay at break even and start to chip forward and then raise from that position, which is a position of strength, right? It used to be that you could go as deep in your working capital as you want. As long as you have huge growth metrics, then someone will want to back you. But now I think you have to prove to yourself in the market that you can run without external capital. And then that external capital, when it does get inserted into the business, is used for something specific rather than just used as fuel for the ongoing business to continue to go. And I think that's the difference in the way we're doing forecasting. And it does mean that when the founders we work in want to talk about a transaction, it's usually because there's an opportunity that's presented themselves or they know what they want to do with it, opposed to, I just want to get through next quarter.
I think that's why the rule of 40 kind of definition helps you try and balance the growth and the profits and how far you go either way, because at the end of the day, you hit a rule of 40, it demonstrates high growth and or profitability. And if you're not profitable and your rule of 40, then you got 40 plus percent growth. You can try and manage the tolerances there in order to get the right outcomes.
And I think we unpicked in a previous episode, none of us are exclusively in SaaS investing or support. We have a much broader view and a broader portfolio, but this kind of concept of balancing growth and profits is an important one because those growth at all costs days are sadly behind us. They were very fun when you're in them.
Yes.
But we're in a different stage right now. Ryan, you kind of started talking about the work that you guys are doing. Your business does a number of things in supporting scaling up businesses. So what does a good financial setup look like as you're going through scale, and how do you leverage, virtual CFO and accounting services like yours?
Well, I have a biased view, but I like a tolerable level of investment in the finance function. Like, it's not this kind of concept that you raise and you have a full-time CFO and 2 accounting people and you start talking to Oracle about, what system you're going to use long-term. No, it's about really making it fit for purpose and stretching out the money so that, well, if in the event that you raised, you can put as much into growth or as much into operations and keep the finance function lean. We provide that as a service because we think that lean finance function through the first 1 to 3, even up to 5 years is the right balance. And we like to consider use of good tools, software, some outsourced labour, coupled with strong strategic advice from us is actually much more cost effective than junior team members that are sitting in the office or CFOs that are full-time and very expensive. So there's different combinations.
We talked about on the last episode, the concept of AI is driving our cost, and there's an expectation now where AI is playing a role in your organization. I think staying lean is more relevant than ever before, right? So I would really agree with that. And I think what you're saying is keeping the finance function lean and mean is key as well, right?
Yeah, and I think extending the use of things like Xero to its maximum capacity, or you might be into QuickBooks or something like that, but some sort of cost-effective cloud-based system with a few good integrated apps to get you through the first 3 to 5 years without overthinking that you want to go and invest in an ERP or get a really big team. I think you want to find fractional elements, but I think what's important that I often tell people that with a finance function and using, say, virtual CFO is that there has to be a combination of dedicated and non-dedicated resources. Like, for example, if you're large enough and busy enough that you need someone in accounting or bookkeeping, there should be at least one dedicated resource there, and then the rest can be, fractional or non-dedicated. When it kind of falls over is when you have part-time bookkeeper, part-time CFO, part-time tax agent, and then everything's sort of fractional, everything's part-time.
Yeah.
There has to be one of those chains, and clearly not the tax agent, that needs to be dedicated at the right size, especially if you're doing 1 million plus.
I think you've got too many founders that try and do everything themselves, and we see that finance often takes a back seat, that some lack of discipline in relation to the finance function. So I think however you do it, you need to have a considered plan and balance those things out. It's so true.
Finance is the poor cousin in the entire business operation, and you do see some overinvestment there, but rarely. But people do misunderstand, it's the right time to hire a full-time person. Now it is, and I'll go and get an intermediate accountant or a junior accountant. And there's so many better combinations to that, where you get a little bit of strategic, a little bit of high level, and then you've got sort of the base level parts. The worst thing you can do is in a startup is that, when you have enough to fill one FTE of work, the last thing you want is, a 1 hourly rate doing the most junior things to the most senior things. Because whether you pick someone senior or someone junior, you're going to have this massive efficiency loss either way, or effectiveness loss that, I think, the way that we do it is kind of unique. There's a lot of people out there that do CFO advisory as a sort of one man or one woman army, and they have 3 or 4 clients, and they sort of hit their maximum, and that's cool. I think that's a really great and important thing for the ecosystem. But the way that we do it is more on a firm environment where we'll have 3 or 4 people assigned to one client, and we'll bring in financial modelers, senior accountants, controllers, and a CFO level person, so that they can have a unit that can sort of help them. And we can get through much more work as a result of that. And we're actually doing a combination of heavy lifting and strategic work, where opposed to there are some people out there that will stay particularly high level and are definitely expert in their relevant industry. But then as a result, they're not able to pull up the finance function at the core level and actually improve things and get their hands dirty. And it kind of there's sort of lacking a level in the middle between strategy and almost transactions. There's almost a middle ground that you have to fill as well.
We think about this, a business that's scaling or wanting to scale, because you do the virtual CFO, you do some corporate advisory, you also do some investing, and so when you look at a business that's coming in for support from you, or a business that's coming to you looking to raise capital, what are some of the early things that you're looking at when you get their financial model, either around their disciplines or numbers, ratios? Where do you kind of immediately hone in on?
Is that specific to doing a CFO advisory or more corporate advisory?
I mean, you could take either.
I think when it comes to say CFO advisory is like we often will tell people that they should be doing more than $1 million in revenue before it sort of justifies the investment, even if I think it's cost effective and not too expensive. But I think there is a threshold in those kind of things where it shouldn't come in too early. We would look at a lot of things like because when you're doing virtual, or remote consulting, even though we could be in the same city and meet up regularly, you want to make sure that the systems are aligned for it. You want to make sure someone's able to work in that environment. So you've got to kind of qualify for the right reasons. And also you want to see that you can actually add value. Like there are so many times that we'll go into a business and things are reasonably well set up and they may or may not need the support, and you kind of want to understand, like, how are you going to drive value for them? What needs to change? Is there some sort of greater need that they're actually going to get the value back out of it? And then when it comes to corporate advisory assignments, I think you have to look at a lot of things. You have to look at you have to look at it in the same way as if you were investing. If you're going to take on a mandate and take someone to market, you have to believe in the founder, the story, the credibility, the financial hygiene, the numbers, the past raise, the valuation, because you become as much of the storytelling and trying to find investors for them that and you might take some equity in as well. That you have to think of it in the same manner as if you were thinking about investing yourself.
Do you find that, like one would say, accountants are conservative in nature? How do you balance founders want to grow and profitability?
It is a tough one, and I would say that we're not that conservative overall because we work in this space, right, where it is reasonably, it's high risk, high reward at a lot of times. I think that our role with founders is to help them take calculated risks. That is like the number one thing that we do. And I would say also responsible risk taking, because it also can be other people's money at times, and making sure that they have good governance. Do they have boards? Are they meeting regularly? Do they know what's going on? And making sure that everybody can see the picture, whether it's the finance picture, and see that they're making the right decisions, whether that's with the right approval or with the right considered and discussion. But it's all of those things. Like there is a conservative nature to accounting, but the most important thing that we can do is we can give people visibility over their own business and also their boards and also their investors, so that there's some sort of collective decision making in that, opposed to just talking to your tax accountant specifically around whether you're spending too much money on something. We're not conservative.
So if we take that view, if you're in there as a strategic partner, you've got the visibility over the numbers. What are some of the metrics or things within a P&L or businesses dashboarding that you see as a CFO and an investor in other businesses that would encourage you to say to a founder, like, now's the time to grow, now's the time to take calculated risk or accelerate your plan? What are things you look at there?
I would say, and this has changed, right? One of them would be if they wanted to, like raising capital, like strategic use of funds, I would say, is one. One is demonstrated profitability or path to profitability in a short or near term environment. I think those are the main things. Like right now, it's about profitability. It's about strategic use of capital rather than ongoing burn.
That's really great, Jay. We've spoken a few times around our view from a utility side, and that you have strong conviction in your plan, and you kind of know what you're going to do with it.
The plan needs to come first, right? We often get people come to us and go, "Oh, we just want $1 million," and we go, well, "What are you going to spend $1 million on?" And they go, "Oh,
working capital."
Yeah, right." And they want to hire one guy, and there's and I always say, the plan needs to come first. The amount of money that needs to fund the plan, is what you want to raise. And often we do double shuffles as well, because there's sometimes the businesses are not in a position to, they don't have all the signs that can validate a successful raise. And so we'll have discussions around a double shuffle. Double shuffle is when we do a specific plan that gets us to more verification and more signs of success that will set them up well for a future raise and maybe a future larger raise. So you minimize dilution, you do a smaller raise at a lower price, you get to your goal, and then you set yourself up for a follow-on raise, as an example.
There's something similar that we do there, which probably goes on to that question just prior, is that there are a lot of people that we talk to and do some planning work with, and then we set KPIs for them to sort of come back to us with, and it may be 3 or 6 months later. And then when it comes to actually quantifying the raise amount, we generally will wait for some detailed financial modelling work rather than to sort of get early where you just see $1 million broken into 4 chunks. It's more like, how do you know how much you need to raise until you do the work and think about it? And it could be 1.3 million, you know what I mean? Rather than these sort of kind of these rounded numbers that kind of almost make no sense.
Yeah, I think when you go through you get a nice pretty capital raise deck, and you've got this really nicely designed use of funds slide that says
pie chart.
Pie chart.
Sometimes.
Love a pie chart. And so we're gonna use 40% to sales and marketing, and then you get the financial model, and sales and marketing is one line that just is flat lined out to make up the number that is going to be
used. And we know straight away, right? Like you look at it and you go, clearly that's not going to be the case. Or you're bringing on all this extra revenue, but you've added no people or resource or consideration for how you're going to execute on that. Like, does sometimes that people think we're silly? I think that's a thing, right?
Actually, the use of funds pie chart is actually very hard to sometimes work out, because sometimes you'll have a business that has cash and working capital, and then you put in the investment money and it just goes into it. It's almost like pouring a glass of water into a pool, right? You can't actually then work out, well, how much of that dollar exactly went to the other thing. But yeah, you find that those things are usually kind of reverse engineered to a point. But I think it's I think when it's rounded and it's not strategic, and then it just doesn't align back to the story, it's actually a little bit challenging. And the numbers are rounded. Like we generally would be like, let's do the work to work out how much you need to raise. And then the stark difference to how you would have done it 5 years ago is to not assume that you can continue to raise money. Like if you think you can raise, you have all of the right KPIs, and you've got potentially interested people already talking to you, then what's the amount of money that is the right balance of dilution to raise once, get to profitability or close to and break even, and then consider your options for a strategic Series A with intention to do something prolific, whether that's expansion, maybe some M&A, but something that you can like almost touch and feel.
We're big fans of an M&A motion. Like I think that you got to be open to doing both organic and non-organic, and do whatever it takes to try and sometimes get there. That's been a very successful model for us. Josh and I have done that many times. Right. To drive the right outcomes. And in addition to that, I think the other thing as well is it's not just the financial metrics and signals that you need to consider. You need X amount of logos. You need to be entering certain geographies. You need to be bringing on certain partners. It's all the validation that you can in order to set our raise up for success. And the reason I'm delving into that is because one wise person said to me around the podcast, show them how to do it. Right? How do you get out there and raise the money? What do you need to do to raise the money? And I think that is all the above that we've been talking about now, right? But it's not just the financial, it's the non-financial, it's the science, it's the partners, it's all the above that you need to set up a proper raise for success. And it's okay if you're not all the way there, but then consider maybe a double shuffle. What's the minimum you need to raise, maybe on not as good terms, to get you to the next phase?
What are some of the common mistakes or pitfalls that you see founders make when it comes to managing their financial sustainability and profitability?
This is going to be fun. Let's go.
It is interesting. Yeah, I think there's a few things like misinterpreting burn. The amount of people that will open up their accounting file and look at it and kind of go, oh, I burnt this much last month, and it's just the movement in cash accounts, or they're looking at EBITDA as a proxy, or they're looking at profit, and they're also looking at numbers which flux and may not necessarily be right. And then you have like, and this might change over the next few years, but like the nature of SME business has like a really strong quarterly cash flow cycle around, super, which will change, but payment of GST and other quarterly items, and the cash flow cycle kind of moves a little bit odd. But if you think about, they'll go look at their bank balance and see the movement, and it can be impacted by AR, AP. But I'm just making the point that when people think about burn, they've got to actually really think about whether they're actually taking that into the right amount. And there's two concepts there. One is like, how much what does it cost to run the business on a month, and then when will I actually run out of money? So that's definitely a huge one.
It's the rose-coloured glasses, right? I think that's very true. And we've had that conversation where somebody said, oh, now we're profitable. And then I'd lean over to Josh and go, Josh, they're not profitable, are they? And he's like, no.
It goes the opposite, where someone goes, oh, we burned $200,000 in January. And you go, yeah, but you paid your quarter bass and your super, and next month it's going to be 110. And then like, what is the actual number here? Because sometimes people will freak out and then react on the back of that,
Yeah.
or they will, just go and think about raising or different things.
We've talked about the key metrics, right? Like we control, like having the right dashboarding or whatnot, so that you can try and balance some of those things is been very important for us. What are the numbers that we need to track? Because if we track the right numbers, we can kind of keep people in the right phase. But I agree with you that even just new businesses that come and talk to us, we find that there is that rose-coloured glasses implications for sure.
Yeah, look, there's other things around sort of hygiene and how often they're doing things. Like some of the pitfalls for me are, people that don't have some type of structure around their finance governance, and some people have the benefit of great mentors, great advisors, or a great board, like a statutory board, or there could be investors on the board. And sometimes I just think that those are just really great forcing functions of what people ought to do, which is that, you should have an accounting close, you should do it on an accruals basis, you should compare it to a forecast, you should try and close it within 7 to 15 days of the month. It should go to other people for feedback. There should be some level of accountability in there. That's the thing that I think I struggle with, is where people are, they have investors, but they have really loose understanding of their reporting requirements to them, which may be quarterly and often forgotten.
Do you have clients that would be very positive to investors, but when you guys have conversations, you go, oh God, what are we going to do? What are we going to do? Like, because I think we obviously, like Josh and I play the investor lens, like we definitely play that role. And I think sometimes people want to tell us good news, right?
Sure.
We are realists in the fact, and we also can look through financials with discipline. So I think sometimes they feel it necessary to portray a more positive circumstance than maybe what the reality is. That's a fair thing, Josh, right?
Yeah.
We definitely get that challenge.
Yeah.
We often don't believe it, because we can we're experienced enough to kind of see through that. Like investors are not idiots portrayed, Yeah.
There's an element to what we do, which I often refer to as like we are independent of our clients, and when we have, or sometimes we'll have the investor suggest that we get involved, or the founder does, because they want to increase their own financial literacy or hygiene leading into an event,
Yep.
or it's just time because things are getting harder. But I think that an external CFO who's clearly independent, and has an agenda of just making sure that everyone can see the business exactly as it is, without necessarily, wanting to sort of pursue a certain, narrative around the numbers, because there's generally, limited ways that you can sort of portray things that aren't just accurate, right?
We used to call that ZOOD, zone of uncomfortable discussion. Josh and I would sit down and try and deliver difficult information to founders that may not want to hear it, right? It's a sensitive way of, challenge.
It's so interesting hearing you talk about the way that you approach working with a business as a CFO and as a strategic partner, because a lot of it mirrors pretty closely to what Jono spoke about in our previous episode around growth, in terms of being able to interpret your numbers, having good visibility, having a pipeline and idea of when things are closing, comparing it to targets and a forecast. And it, in businesses that I've seen and work with, it's interesting when you first get there and there isn't a good interpretation of the numbers. They aren't closing in 7 to 14 days. In some case, it could be a month behind, and not always comparing to an accurate forecast or an out-of-date forecast. You just wouldn't allow that in a growth and a sales function, because you're so geared towards growth and you want to have that visibility. But how many businesses will have those poor science practices in the finance and profitability function?
Many of them.
And it's hard to make decisions in a business if you're 30 days behind and you're not interpreting your revenue or your costs or these things correctly.
I think it would be hard for you guys to have a good look at things, because there's some good businesses out there that just don't have all that stuff put together neatly. And look, I think that's kind of like the role that we play, right? We want to make sure people can make good decisions. And I often say, and I might do us an injustice here, is that there's an element of our work which is non-strategic. And that is like all of the base level stuff around closing and accuracy and showing people their own numbers. Like we generally will allow the founders or the investors to actually see the business themselves to make their own strategic calls, because we won't often overstep the mark and assume that we will know better than someone in their specific industry, and we will contribute to that strategic discussion. But at the end of the day, we want to be able to make sure people can make strategic decisions with their numbers that are accurate, current, and compared to something, generally there's some accountability, but just highly accurate numbers. Like we have a lot of things that we have low materiality concepts, we have accruals, we have cut off, and we try our very best to shape their finance function and their thinking around.
Otherwise, what happens is that the businesses will find out too late when they really have problems. And I think part of that is because they think that we're just going to open our checkbooks up and write a check, But it's interesting though, like if they knew their numbers, they would know way ahead of that time that they have a problem.
We have a recurring part of our show, which is around a fast 3 questions, and we'll take them from a financial lens this week. What's one piece of financial advice or scale-up financial advice that hasn't aged well?
I think it's grow at all costs. I think that's old. I think you said it earlier, and I was going to say it because I think it is really really ugly these days. It's not grow at all costs. It's grow with discipline. It's grow with some type of balance. And I've really warmed into the rule of 40 in the last couple of years because as you guys know, we're not tech specific. We do have a number of tech businesses, and we do monitor rule of 40, and I've actually gotten a little closer to that over the last 2 years, and I think it is a really neat balance. But I think it's grow at all costs, or this concept of 10x, why 10x when you can 100x or something like that. I think that's kind of. I think
that makes so much sense, mate. I agree, absolutely.
I do appreciate, I think the rule of 40 is a very good kind of guardrail and test. I did have a founder send me a deck and a financial model where they explicitly told me that they put rule of 40 calculation into the financial model.
Come on!
I like that.
I love it.
Because they knew I was going to go looking for it. So that was really nice. The flip side of that, the positive side, what's one piece of advice that has stood the test of time and is still relevant now?
I think it's about what you do around when you're talking to people, whether your actions or the things you say, and the idea of that it could be published in a newspaper or something like that. That's a big one. I've often said that internally in and around our team, that whatever we do, just kind of work with that understanding, which is quite interesting because I think newspapers probably won't stand the test of time. But that's the thinking. I think it's about just making sure that whether it's the way you work in personal or in business, the integrity factor is immense.
Yeah.
And we take that seriously.
Reputation is everything, right? At the end of the day, right?
Yeah. Well, especially in whether it's your investors or you're in a consulting business like ours, everything you do is reputation.
I mean, Jay, I think when we first met nearly 10 years ago now, and you invested in a business that Ryan and I were both working in, one of the pieces of advice that you were giving me was, treat every dollar like it's your own. I was in kind of growth and sales at that point and followed that on. And I think that's still good advice to any founder, particularly if you are going out and you are looking to raise external capital, friends and family, or, angel and VC, private equity, treat every dollar like it's your own.
And look, I think sometimes we make it look easy to raise money, but I think it is a very difficult exercise. At the end of the day, great outcome, but quite frankly, an awful lot of work that goes into it. So it is definitely not easy, and you shouldn't take that for granted, right? No question. Spend it like you're its own, just in the event that you don't get any more, remember?
And if you're a founder, what's one thing that you'd encourage them to go and look at, across their finance or profitability? You can have a couple if you have more than one of places they could go this afternoon and have a look at.
I think I should go. Look at their balance sheet. There's so much stuff hidden in people's balance sheets.
I agree.
Terrible accounting to mess, and people when we do our work, we take a balance sheet first approach when it comes to closing the accounts, because you can look at a P&L, and if you have two succinct and accurate balance sheets between two periods, the P&L is accurate in between, and it's just a matter of classification. But people will look at a P&L and go, oh, that's cool, and then they'll look at their balance sheet and go, well, there's all this sort of old stuff in here and miscoding. So we take a balance sheet first approach, which is kind of almost like an audit style approach.
We'll see it, right, as well, right? You can, sophisticated people will see.
No one runs the balance sheet. No one thinks about deferred revenue. I mean, I think some of the more mature SaaS businesses will think about, rev rec and things like that, or they think about capitalization and policy. But the worst thing you can sort of see is people where it's like, oh, we just do that at the end of the year. You're kind of like, okay, then what are you doing in the middle, and who are you reporting to, and what are they not seeing, those deviations? And then you have these accounts where all this stuff happens, and then 30th of June comes around, and then all of a sudden all these entries get booked, and it's also 6 months later when the tax return's being done. So we have this view where it's like every month everything gets done, whether it's posting depreciation, whether it's provisions, whether it's rev rec, all these things that people would just go, oh, we'll just do it at the end of the year. We do all those things, tax provisioning, everything, every month.
It's so interesting. I was going back and having a look through a number of the recent kind of decks and things that we've gotten from founders at how many sent through a data room that had financial forecasting in it with a P&L only, or a P&L and cash flow where they said, we don't have any big heavy, asset, purchases. But when you push them on it and you say, well, let's see the balance sheet, there are things hidden in there, material things from not only an investor's perspective, but operationally how you're going to run the business. And even if you are a tech company or a software company for that matter, that, it's a lighter balance sheet than other businesses, but it does really still matter.
It matters so much. It matters on the accuracy of all the numbers. And like when you have, and it gets more complex when you have, say, multi-entity and subsidiaries overseas, and making sure that intercompany balances, because you can sort of miss an expense on one side and not recognize in the other. But like there's just so much in that around the hygiene for sure. Look, I do subscribe to you don't have to always have a three-way forecast, but you kind of need the balance sheet to be right to inform, even if it's a two-way forecast in the first right.
Yeah. You can't compare. I think the concept of you may not need a three-way forecast, you're going through that process, but there needs to be a maintained balance sheet and something that you're looking at operationally. Yeah. You can't discount it altogether.
No, not at all. And I think if we're talking about forecasting and one, whether this is a suggestion or just a pet peeve of mine, is that when you go and open up a forecast, there's probably two things that you want to see as an external or someone trying to add support, and that is one is an integration of actuals and forecasts, and that cascading story making sense across the line, which is where actuals and forecasts meet. It doesn't never really make sense when you kind of take the actuals and the forecasts and they're in separate documents and they're just completely misaligned. And also the structure of those things, that if in the event that you want to compare back to them, you should at least ensure that your forecast and the way you report back are identical by way of the way the accounts look and the structure of those things. Otherwise, you're just going to have these things as disparate spreadsheets that really just get used for that one purpose and then end up discarded.
Yeah.
A mentor of mine in the past used to tell me that growth and this side of the equation is the kind of wind in the sails, and it's going to take you a long way. But if you aren't watching profitability in your finance function, then you're not steering the ship, and you could end up anywhere, including running aground or in a direction that you don't want to be.
We are often having to fix a lot of these things ahead of time. People come to us and say, we want to raise money, and we're like, they're not necessarily ready because they don't have that level of hygiene.
Yeah.
You got to clean it up. At the end of the day, the investors will see straight through these type of things. So, got to do it right.
I think the worst thing you also can do is to go into a DD process, whether that is on a raise or a sale, and then to sort of get tripped up, and you've got other third parties that are bringing in sophisticated approach into reviewing those, or they're bringing in accounting firms to run DD, and then all of a sudden you're really on the back foot in those sort of things. Is that you've got to get that clean before you do it, I would say, for sure.
Definitely.
And the amount of, when we have our portfolio clients that are going through some type of transaction, it could be all types, is that we generally will see an exceptionally smooth DD process on finance, which we feel really proud about.
Yeah.
But we think it's a huge asset in the success of that transaction as well.
Well, I think you go to all this effort to get investors to the table, to actually get them to say, yes, we want to invest and give you a term sheet, but then to fail in DD, how stupid are you? Right? Seriously.
Yeah.
Don't stuff it up. It's hard enough to get them to the door. Don't slam the door in their face.
That should be the kind
right?
of, it should
on.
Should be reasonably downhill from that first, non-binding term sheet. But when it becomes like ups and downs and it gets really protracted, then it gets really, really.
The other thing is when it comes to valuation, right? Like they will remove the debt off. There is a whole raft of things that define how a term sheet will typically dictate that will mark off the val, right? So if you don't have all those things sorted and clear, they're going to end up coming off. Just a thing.
Yeah.
Ryan, this has been incredibly insightful. We appreciate you bringing your experience and your background and the work that you do to the Rule of 40 podcast. I think there's a lot for founders to take away from today. So huge thanks for joining us.
Thank you so much.
This has been a really useful conversation for us at Utiliti, and I hope it has been for you. If this is something you enjoyed, check us out on LinkedIn, Spotify, YouTube. Share it with a founder that's navigating profitability or growth. Thanks for listening, and we'll see you next time on Rule of 40.